Failed swings often mark the end of a move or start of a reversal. Thank you for watching Cashflow Marco TV. Be sure to like, comment, subscribe. Hit that notification bell. If you grab any value from this video, share it with a friend. Shall we begin? Let's talk about a subject that looks small on the chart, but makes a large impact when it comes to institutional trading. The failed swing. It's simple, yet powerful. And once you learn it, your entries, your exits, and your market bias will get way sharper. A failed swing happens when price tries to continue a move but doesn't break the previous swing high or swing low. In this diagram here, we see an uptrend. In an uptrend, price is supposed to make higher highs, 3 touches to the upside. In a downtrend, you expect lower lows, 3 touches to the downside. That's when price pushes and fails to take out that level. It stalls, rejects, and may even reverse. This triggers stop losses, inducing traders into false breakout positions, reversing in the intended direction. Why it matters? It's more than just a random pause. A failed swing can be a major clue in the market. Here's why. 1. Liquidity buildup. When price doesn't break structure, liquidity stacks up below. This gives institutions a reason to come back later and clean it out. 2. A shift in momentum. Failed swings often mark the end of a move or start of a reversal. 3. Entry and exit confirmation. When you spot a failed swing at your confluences, like an order block or a fair value gap, it adds serious weight to your setup, giving you edge. Now the fun part. Here's how to spot it. We want to look for 3 key signs. Price approaching a swing high or swing low. Price fails to break the failed swing, and it either is consolidating or reverses sharply. Now the fun part. Here's how we spot it. We want to look for 3 key signs. Price approaching a swing high or swing low. Price fails to break the failed swing, and it either consolidates or reverses sharply. So here I have a diagram of an example, and I'm going to give you an example. If price is pushing up to an old high, a buy side liquidity zone, but it fails to break and drops instead, that's a failed swing rejection. Institutions might have just sold into that. So here's buy side liquidity, here's our failed swing, and price is pushing to the upside but reverses off of this failed swing, validating the failed swing. Let me give you a bonus. Confluence with order blocks. Failed swings often align with order blocks, reinforcing their significance as strong entry zones. So let's recap and tie it all in together. Failed swings are warning signs and entry signals. They tell us that the market tried to move, but someone said nope, the banks, and price respected that level. Train your eye for these and you'll start moving like the institutions. Not chasing breakouts, but reading the story between the lines. Like this lesson? Comment below if you spotted a failed swing recently. Like I always say, I have a lot of value and a little time to share it. Thanks for watching. Peace, family.